Hi, everyone. Thanks, Sid, Jonathan. They teed us up beautifully, actually, because I think everybody is now paranoid that cyber is really a growing risk, right? So I'm Lesley Ritter. I'm with Moody's Investor Services, the credit rating agency, and I'll be co-presenting with Chris Hepner, who's sitting right over there, and he's with the teammate Cyber Venture. Before I get started, I just want to get a sense if everybody knows who Moody's is. By show of hands, okay, so about half the room has heard of who we are. We're one of the largest credit rating agencies in the world. We rate about $70 trillion of debt globally, from your local school district all the way up to your large multinational conglomerate. And we basically assign credit ratings that are supposed to capture the probability of defaults and the loss given default of a company if it defaults on its debt. Why people care about this is our ratings impact the cost of money to the companies that you represent, and that has a direct effect on the bottom line and your stock price. So that is why we matter. The higher the rating, the lower the cost of debt, the higher profit, and the reverse is true. So Moody's is now focusing more and more of its time on cyber. We created a cyber team within the rating agency about a year ago because we do realize that it is a growing threat. It doesn't seem like a week goes by, a day goes by without some kind of a cyber attack reported. And we've determined that we need to have more transparency around how we think about cybersecurity as it pertains to credit. So our key message at this point in time is that we view cybersecurity and cyber risk as event risk, but we see a rising tide. So this is very Moody's talk. Event risk is something that you can't foresee, and we don't rate to that. So we don't rate to a hurricane or an earthquake, right? And we don't rate to cyber events at this point in time. But the rising tide captures the fact that the frequency and operational, reputational, financial impact of these events is growing, and at some point it could tip into something that that requires us to be more prescriptive. So the best example I can give you there is not in the cyber world, but when it comes to, you might have heard about ESG, environmental, social, and governance risk. In the E realm, what happened with the California utilities over this past couple of years, there's been a lot of wildfires, right? And we had never really rated to wildfire risk. It was just something that existed, and it happened occasionally. But it became to be so frequent and so material that it caused us to take rating actions on these very highly rated entities and bring them down by 3 notches, which is pretty substantial within our world. So it went from A-rated companies to BAA-rated companies. We're not there with cyber at this point in time, but it is something that is kind of, the approach is informing how we are thinking about cybersecurity. The second key message is that we consider the financial impact of an attack that could lead to a weakened credit profile, so I just gave you an example of that. And thirdly, we've identified 13 sectors that we view as elevated risk with regards to cyber. And I'm going to go into these 3 points in more detail over the next few slides. Let's see. So cyber risk is event risk, and there's a rising tide. The simple way to think about it, and I think the prior presenters kind of hit on it a lot, but there's really 3 drivers of this rising tide. One is digitization, greater intersection of supply chain, connectivity, access to data. All of these are being rapidly adopted across the board, across all industries that we analyze. And it's not always the attention to security when adopting these new exciting technologies that give a lot of efficiencies, cost efficiencies that customers like. Security is not always front of mind. So it is creating a greater attack landscape for threat actors. The second driver is attacker sophistication is increasing. The scale, frequency of the attacks is growing. We've seen, like I mentioned before, every day it seems like another school district, another healthcare institution is falling victim to ransomware. But it's not only them, it's the bigger corporations like Norsk Hydro, like Travelex, we just heard over the Christmas break. So more and more attackers, and attacker skill sets are increasing. We've heard of a number of well-publicized or not publicized cyber weaponry leaks that went into the ecosystem, and actually it's not only nation states that now have access to very sophisticated cyber weaponry, you also have what you could consider B players having improved skill sets. This is requiring companies to constantly have to improve their defense baselines, which is rendered very difficult because there's, as was mentioned prior, there's a significant talent gap out there, and it's very hard to find people who have the skill set you need to help protect your systems. That's made even more difficult because oftentimes you're competing for these same folks that would do the digitization adoption to do security. So that's been a challenge. And the third reason for the rising tide is really that the financial impact has grown significantly. So some examples of that is NotPetya in 2017. Total cost estimate is about $10 billion. $2 billion of those $10 billion is split across 5 companies. That's very significant. Another example is Equifax. After the settlement last year, the total cost of the Equifax breach reached $1.4 billion, and it actually led us to take our first credit rating action on a company. So the company went from Baa1 stable, which is, when you're a Baa1 rated company, you're not really expected to move very much. So if you change your outlook to a negative, that's a sign that it's very material. And the big driver there was the cost of the breach was so significant that we don't think that their financial ratios, their leverage ratios, will be able to recover to a level that's commensurate with where they need to be for their current credit rating. The third example, not listed here, is some of the fines that were levied last year following the passage of GDPR. So we saw both Marriott and British Airways being given fines of $200 to $300 million each for data breaches that had happened. Importantly there, when a regulator levies a fine on you, that's not covered by cyber insurance. So that hits the company's financial profile very directly. Oops, excuse me. So we've established that there's a rising tide, but it is still event risk. And one of the drivers for it to be event risk is we don't have data, the data that we need to run our financial analysis and sensitize the financial forecast that we have to determine what the impact of a cyber attack would be. But that's slowly changing, and we're seeing some green shoots there. If you look at some of the privacy frameworks that have passed, we mentioned GDPR, New York Shield Act, California Consumer Privacy Act, we're starting to have more data points to use in our analysis. On the other end, the data pertaining to attacks that cause disruption are much harder to come by, primarily because they're not reported. They only come to the public really through media coverage. Disclosure rules are still very much materiality based. So it's basically in-house counsel along with the executive teams that decides whether or not disclosure will be made about a successful cyber attack on a company. There is some change that we expect to come there as well. The SEC in 2018 passed guidance on cybersecurity disclosures. Chris was actually one of the authors of these disclosures, so he'll be able to tell you more about it. But it basically encourages companies to be more prescriptive in what they report, how they report, and the timeliness of their report. They're encouraging companies to really think about cyber in a similar way as they think about their financial risk, as operational risk, as governance risk. And cyber should also be discussed in more details in their public disclosures. To that effect, we actually looked at 130 disclosures last year across the 13 sectors that we deemed as elevated risk, and it's been very interesting to see that maybe the maturity of the disclosures and transparency of the disclosures varies greatly. By far, banks and telecommunications are way ahead relative to other sectors. They consistently discuss cyber as a risk. They'll also give us a fair amount of details over the oversight structure of cyber. And they'll also give a fair amount of discussion addressing how they're managing the risk. They won't only mention cyber insurance. They'll also talk about the fact that some of the detailed mitigation strategy risks that they've adopted. Middle of the pack, you could think of retail companies, technology companies, health insurance. They'll typically consistently mention the fact that cyber is a risk, and then they'll say, oh, and we mitigate against it through cyber insurance. The laggards, manufacturing and autos, hospitals, transportation services, do not even consistently mention the fact that cyber is a risk. And when it comes to mitigation, there's very little information there. We would expect that to change over time. There's still a stigma that the more you disclose, you're putting a target on your back. But I think if you look at what the more mature sectors are doing, they're being fairly transparent with the investment community or the community at large about what they're doing without disclosing their detailed approach that would allow a threat actor to really take action. So there's a balance to be had there. So Moody's developed a internal risk assessment framework. It's still a very qualitative risk to think about cyber at this point. We only look at the sector level. We're not yet able to go to the company level. We hope to get there at some point. But right now we look at the sector level. And we had to create a very broad framework because, again, we're looking at school districts and we're looking at big international conglomerates, right? So the two, when we think about cyber, we think about it across two lines: vulnerability, so how vulnerable you are to an attack, and then impact, the reputational, operational, financial impact of an attack on a given sector. We scored both of these factors across the different sectors and created a relative ranking, which I will show you the results of shortly. And it's important to note that these assessments did not consider individual company mitigations, but we did capture mitigants that are applicable across a sector. So if you think of a utility company is vulnerable, it's an attractive target, but from an impact standpoint, it operates under a monopolistic structure. So if it is hit by a successful attack, we would expect it to be able to pass on some of the cost, if not all of the cost to its end customers. This contrasts with the retailer, for instance, who operates in a fully competitive environment and doesn't have the margins to absorb the impact of the financial impact of an attack. And again, our assessment considers the overall financial impact of an attack that could lead to a weakened credit profile. So here you have an illustration of the framework that we use when we think about cyber. Again, two factors: vulnerability. Under vulnerability, we think about business size and profile, sensitivity of data collected. We look at services and essential products. On the impact side, we'll consider brand impact, legal and regulatory consequences, financial impact. These components of these factors are more or less applicable depending on the sector you're looking at. And when you put equal weight for both, and together it gives you, we assign a risk level to the sectors. So you go from high all the way down to low. This is the results of the analysis that we did last year. We expect to update this in the fall of this year, but at this point in time, this is how we view the different sectors. We've identified 4 sectors as being high risk. Those are banks, securities firm, market infrastructure providers, and hospitals. Those account for about $13 trillion of globally rated debt. And then you have another 9 sectors that are medium high, and those include transportation services, manufacturing and autos, medical devices, and the like. I think these will be distributed to you all, so you'll have access to it. And again, this is a very live heat map, so we will be updating this on an annual basis. The results of our study, like I mentioned, $13 trillion of globally rated debt that is we view as being high risk. That is at the sector level. The individual company mitigants aren't factored in here. Some of the key kind of common characteristics for companies that are deemed to be high risk are tied to the fact that they're rapid technology adapters. They rely on a lot of data, and they have limited ability to fall back on manual processes. On the flip side, those that are more most deemed lower risk have not adopted technology at as fast a clip, and they also are less sensitive to brand and reputational issues. Another finding that we had is that we continue to think that operational disruptions is more material, and this is a greater credit risk than data disclosures. So if you think of NotPetya versus some of the data leaks that have happened, but still that doesn't mean that data disclosures aren't damaging. Again, we moved the credit rating on Equifax last year. And finally, as I said, we're still at the sector level in our analysis. That's where we started. Broad sector. This year we're moving down to kind of subsectors to try to get a better sense of if we can differentiate within the different areas within a sector. And our goal is to, over time, get to the company level cyber risk assessments. So that concludes my remarks. I'm going to pass it on to Chris now.